And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Ben Johnson, Director of Global ETF Research at Morningstar. He's out in Chicago. And Todd Rosenbluth right here with me, Senior Director of ETF and Mutual Fund Research at CFRA down here at the NYSE. Let's start with a sell-off today. Stocks under pressure after trade tensions escalated over the weekend. The Dow, the S&P 500, the NASDAQ all down around 1%, but well off the low. Trade-sensitive sectors like materials, industrials, technology, of course, they're the ones getting hit the hardest. Ben Johnson over in Chicago, we're off the lows of this session. Is this a constructive sign that buyers are indeed coming in and buying the dip?
Well, I think this is a sign that the market's hanging on the president's every tweet right now. And if investors think that they're going to make any money trying to respond to whatever comes off that particular Twitter handle, they're probably going to lose a lot of money and lose their minds in all likelihood as a result. I think we've seen plenty of these knee-jerk reactions over the course of now many a month. Investors should, as always, take a deep breath, look away from the television, and stay the course, quite frankly.
Yeah, Todd, it sure looks like they don't believe there's going to be a trade war here. I keep pointing out the low print for everything was on the day. Now, of course, semiconductors down the most because that's the knee-jerk reaction. Industrials, the second group, is sell-off, so XLI, which is the ETF for that. But the low print was at the open. Caterpillar's low print was at the open. All of the other ones that are out there, Cummins, your usual suspects on the industrial that you sell off on a trade war, their low print was at the open, and it's been off of that ever since. Who's right here?
We think that there's going to probably be something that gets done between now and the end of the week, or the goalposts will get moved again. The cyclical sectors have continued to lead the market thus far in the first 4+ months of the year. There typically is a bit of volatility in the May to October period. That tends to be the weakest period, and the more defensive sectors like healthcare and staples tend to hold up better. But technology is really the tell. Technology is leading the market higher thus far this year.
And Ben Johnson, he mentioned sell in May and go away. Of course, it doesn't mean that May to October will be down, but there is that 6-month period we have been talking about for a long time. May to October tends to underperform the 6-month period from November through April. How does Morningstar feel about where people should be right now?
Well, I think my hope is for that period you find yourself a couple of good beach reads and maybe not pay as much attention to the market while you're out on the beach over the summer months. I mean, is it seasonally soft? Yes, sometimes no. Whether that repeats this year is really anyone's guess. So again, maybe avert your eyes from what might happen in the markets over the next few months. If you're really worried, rethink of your asset allocation. Think about your mix of stocks and bonds. If you want to maintain equity exposure, think about some of the ETFs that offer equity exposure, albeit a more defensive posture with respect to equity market exposures. Tickers like USMV, in the case of U.S. markets, the iShares MinVol ETF, or its EM cousin, EEMV, which puts together a lower volatility portfolio of emerging market stocks.
Well, of course, we want you all to keep your eyes glued to CNBC and CNBC.com throughout the summer. But he does bring up a good point, which is that volume tends to drop off during the summer month. And this may be one of the factors accounting for the fact that 6 months tends to underperform the 6 months from November through April. And he was just mentioning low volatility, minimum volatility ETFs, which tend to hold consumer stocks, utility names, that may do a little bit better in this environment.
Yeah, the defensive parts of the market that would be heavily concentrated in USMV or SPLV, which is the Invesco lower volatility product, are ways to be able to look at it if you're concerned about the market volatility. We at CFRA, we've historically found that consumer staples, Vanguard Consumer Staples, VDC is a good example of that, or healthcare, which is XLV, would be the healthcare sector. Spider. Those are two good ways to play that from a defensive sector orientation.
Okay, let's move on here and let's look abroad to the China ETFs. We mention them often. They are not the same. They're down dramatically today in the sell-off. FXI is a large cap ETF that's down 3%. The Extractors Harvest China A-Shares ETF, that's down nearly 6%. MSCI China ETF down more than 3%. As we've said before, guys, they're not exactly the same things. We'll explain that to you, Todd. How are you recommending investors should navigate this volatility? You can own A-shares, you can own Hong Kong, you can own all sorts of stuff, but should people be owning China now at all with all this trade war dispute?
We still think so, yes. We at CFRA are positive on emerging Asia from a macro and a strategy perspective. We again think something will get done. We think the earnings picture is relatively strong there. But you mentioned earlier those different ETFs. FXI has more than half of the assets in financials. MCHI includes technology stocks like Alibaba that are U.S. listed. The A-shares products are again different because it's focusing just on that local market. And the A-shares are being added an increased weighting in the MSCI benchmarks coming up in later this month. So exposure to IEMG and EEM is going to have more exposure to the A-shares. You can get in front of that with KBA or ASHR.
Again, this is a choice with how you feel. I mean, personally, I like broad exposure. Why just get China A shares? You want Hong Kong shares. There's listed China shares here. Alibaba is a good example. Only lists here. You don't get that if you just own the A shares. So my opinion would be to own a broad spectrum of Chinese stocks. But Ben Johnson, the key here is there's a little bit of a difference between trade wars and the Chinese economy. They're related, but they're not exactly the same thing. We have seen the Central Bank of China furiously stimulate in the last 6 months. It seems to be having some effect. The numbers have been a little bit better in the last couple of months. There's still a debate about whether we're bottoming at all. Morningstar's thoughts here?
Well, I think most importantly, when you look at the sell-off in Chinese stocks today, you should keep that in perspective and realize that if you own a globally diversified portfolio, just market cap weighted index funds split 60-40 between stocks and bonds, Chinese stocks represent just over 2% of your portfolio. So what I'd be more concerned about is the fact that we live in a globally interconnected world and that anything that takes place with respect to Chinese-U.S. trade relations is inevitably going to have unforeseen ripple effects that might affect global markets. So again, if you're really worried about the implications of these trade talks, whether they materialize, whether they fail, whether they go sideways, you should rethink your asset allocation first and foremost and assess whether or not you're comfortable with your mix between stocks and bonds and the makeup of your equity exposure. And I would agree with you, Bob, that in the case of potentially overweighting Chinese market exposure, we tend to favor broadly diversified market capitalization weighted indexes and the funds that track them.
Well, let's talk about asset allocation. We've often talked on this show about the triumph of indexing. I think that's what we've been seeing here. Let's talk to the man who's in charge of all that. For more on China's impact on the global markets and ETFs, we'll bring in Henry Fernandez. He's the chairman and the CEO of MSCI, and these are the index people. Henry, one of the things that you have been very involved in the last year is slowly increasing the weighting of China's mainland shares into the global stock market in global ETFs. Your emerging market index has slowly been increasing China A shares. Could you just briefly bring us up to date on where that is going? Because the key point here is all of you who own any kind of international funds, likely your weighting in China is going to be going up, largely because of work like you are doing. So bring us up to date very briefly on where is this inclusion?
Yeah, Bob, so in terms of where we are is the MSCI Emerging Market Index is made up of all Chinese has in it a lot of Chinese exposure from different markets. You mentioned whether it's a company listed in New York, Alibaba, whether it's a company listed in Hong Kong, and whether it's a company listed domestically inside China. Clearly, at the moment, the vast majority of the China exposure in the MSCI Emerging Market Index are companies that are listed outside of China because they're free to trade. You can buy them and sell them anytime. That's about 30% of the index today. Now
this is Hong Kong largely, and to a certain extent the United States. For example, I point out Alibaba trades only here.
Right.
You don't get it in Hong Kong. So your index, that what 22%, I guess, would include Hong Kong, 22%, and 8% or more either mainland China and a little bit outside the United States. Your point is A shares, China mainland, the numbers are getting bigger. And you're including more of mainland China.
Correct. Right now, as of this moment, the China exposure coming out from the domestically listed companies, A shares, is less than 1%. In the MSCI Emerging Market Index. Now,
and if it was if it was properly weighted on a global level in terms of market capitalization, the China market is what 1/5 the size of the U.S. market, something like that. But if it was properly weighted, what would those China mainland shares be in a global market index or an emerging market index? What would it
be? About 10%.
10%. So China still is dramatically underweight. Your point is the rest of the world, and that's why you feel the need, and the Chinese have been pushing this as well, to include more of their shares to more fairly represent them.
Correctly, but again, to make the point, the it's all a question of where the China exposure is listed. We already have 30% of the emerging market index in China exposure that is listed outside of China. So if you buy, a product that has the MSCI Emerging Market Index as the underlying, you already are exposure to. These are Chinese companies. They do business in China and all of that. So what we're now facing in is the China shares, the companies that have shares inside China, which is very small today, but as over time, as the weight goes up, it's going to be dramatically higher.
Todd, I think the point here is he said 1% mainland China in the emerging market index that we buy, the EEM, famous indexes. And if it was fully weighted, it would be close to 10%. The point is you're going to be owning a lot more China shares in the near future if you don't own any kind of international, even the global indexes would increase as well.
Right. So if you owned EEM or IEMG, which are well-diversified emerging market ETFs from iShares that are tracking those MSCI benchmarks, your weighting in China A shares is going to be going up. So you can do a few things. You can do nothing and just be happy that you're getting more exposure to that. Or you can get in front of that using China A shares or China broad ETFs that will be including A shares so that you can get ahead of that. And we'll also see mutual funds that track the MSCI emerging market benchmarks having to follow suit as well.
And what's important about this, everybody who's watching, is that these are the people who are determining what you're going to be owning, because as we've said, indexers rule the world now. We're in the ETF business. ETFs are largely a passive investment. So when Henry at MSCI make a decision to include more China shares, you're going to own more China shares if you're in those kinds of global markets. That's why what you're doing is very important. You've included Saudi Arabia this year in emerging markets for the first time. I guess it's small, maybe 2% of the market, but it used to be a frontier market just a short while ago. So the world is changing, and you're trying to reflect that.
Yeah, what we're trying to do is when we look at markets around the world, particularly markets that were closed in the past and now are opening up, we're including them in the opportunity set so that investors can diversify their portfolios and hopefully add return by having them. We have not yet included Saudi Arabia. It was announced, and the actual inclusion, or at least half of it, will be at the end of this month, and then the second half at the end of the summer.
Now, there is some debates about what's an emerging market and what's not, for example. So South Korea is the good example. You include South Korea in your emerging market index, and we all own South Korea because it's in your indexes. But other indexes, some competitors exclude South Korea. They think it's a developed. So you do get into, there are debates about what should be included in these indexes. I call it the politics of indexing. It's a judgment decision on a certain level. Would you agree?
Yeah, correct. In our case, there are certain things that Korea has not yet done to be totally graduated from emerging to the developed market, and particularly the availability of the currency trading anywhere in the world.
I got to ask you about your stock. MSCI, my heavens, 50% up this year. Probably the best performing financial stock. I don't know this for sure, but in the last 5 years, it's just rocketed up. What's going on here? Why does everybody love MSCI stock all of a sudden?
Well, the company is hitting on all cylinders. I mean, the mission of MSCI is to help global investors of all type build better portfolios. So you can see that the opportunity set is very large for us. So whether it's global investing, as we were talking about, factor investing, ESG investing, private asset class investing, we're there.
We got to go, but Ben Johnson, you had a great comment to me. You said MSCI is an asset manager that's not really an asset manager, but everybody's buying them like they're an asset manager. Give me 10 seconds on that. Ben, you there?
Yeah, I mean, if you think of...
Go ahead.
Sorry, if you think of the makeup of the business and the prevalence of the MSCI index suite and the growth of indexing broadly, and to the extent to which the firm collects fees that are directly linked to the growth of indexing and the growth of ETFs more broadly, they're driving a lot of investors' capital, especially at the margin when you look at decisions like the expansion of A-share inclusion, the graduation of Saudi Arabia into the emerging markets. The decisions that are taking place within those walls are having meaningful effects on where investors' capital is being allocated in all corners of the world.
All right, remember everybody, indexers rule the world, and this is Mr. Index right here. That does it for this week's ETF Edge. We have all the best guests right here. I'm Bob Pisani. My thanks to Henry Fernandez, Ben Johnson, Todd Rosenbluth for joining us today. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.